Hi, I'm Victor. Welcome back to my channel. In this video, I'm going to go in a different direction and I'm going to be covering my bond portfolio. I typically, really record videos on stocks as I analyze companies that I look to invest in, or I look at, the stock market and review what happened in the stock market and what my plan is to invest in the stock market. Bonds are part of my overall investing strategy. I have a bond portfolio where I have bonds, individual bonds, as well as a couple of ETFs. And really, the reason for it is as I get older and I head towards retirement, when I retire, I'm going to need income. And it'd be great if I have, a paper gain on a stock that I don't want to sell. Well, that doesn't buy me a lot of groceries. That doesn't pay for my gasoline or maybe a trip that I want to take with my wife. So bonds can really generate that cash and that income that I'm going to want eventually. I want to get good at investing in bonds because I think although today income's not that important to me out of my portfolio, eventually it's going to be really important. So I'd like to get really good at it. It offers up some diversification as I look at my investments. I have investments in stocks, and bonds are a good diversification away from stocks. Right now, they pay a really good return, and I'm looking for these bonds to return 7 to 12%, which is a very good return. And again, I want them to generate that income that I'm going to need eventually. So let me tell you more about my bond portfolio and give you a review of the bond market. The first thing I wanted to cover is interest rates. Provided a video on my channel on February 3rd, 2023. And at that time, the 10-year was at 3.5%. So if you bought treasuries from the federal government, they'd pay you 3.5%. And about 6 months, or actually 8 months later, it's up to 4.795. That's 1.291 full percentage points higher. That's a big jump. And that big jump is really causing a lot of volatility in the stock market, but it's also making bonds more attractive. Looking at how the treasuries have performed over the last 5 years, here's a chart looking at the 5-year treasury, the 10-year, and the 30. And you can see that, in 2019, it began a drop into 2020, and then we had COVID. The Federal Reserve just lowered interest rates. Hey, let's keep the economy moving because we had this giant pandemic, and it really created an really artificial market of low interest rates. Once they realized that inflation became a really big problem, they started to raise interest rates at a very aggressive rate. Over the last 18 months, we've seen an aggressive increase in rates. Over the last 5 years, they've increased, the 5 years increased 58%, the 10-year 52%, and the 30-year 49%. I wanted to go over three types of investments in bonds that I get into. One's a low risk, one's a medium risk, one's a high risk. Low risk first. So low risk is really controlled by your duration, meaning you're essentially lending this money for a short period of time, a year, maybe 2 years max. And in this case here, I'm going to show Chevron and then the Vanguard uh, ETF that really buys bonds that are short term. The yield on the Chevron investment is 5.7%, and that's a pretty good yield, especially since the duration really it's a little close to zero point 0.4, which is going to be, I'm going to guesstimate around 4 months. In 4 months, they'll return basically the par value of that bond, which is the principal, and they're going to return to me my capital. In the meantime, they're going to pay me interest of 5.7%. Historically, the S&P, if you look at historically, it's returned 11.88% over the last 5 years, about 11%. So not keeping up with the S&P, but you're also at very little risk of losing any of your principal. As opposed to a stock, you may buy, let's say PayPal, thinking, whoa, it's really discounted, and you buy it. You might be down 10, 15% over the next 4 months, or you may be up 10, 15% over the next 4 months. That's the risk you take with stocks, but with bonds, you're fairly sure you're going to get 100% of your capital back in 4 months. Looking at bonds, you can also invest using ETFs. And I own both of these investments here. I own the Chevron bond that you're looking at. And I also own these ETF, which invests in short-term bonds. It has a yield of 5.19% currently, which is very good. I think it beats most savings accounts that I can get into. And this ETF is very liquid. I could on Monday morning, sell this ETF and get my capital and use it for something else. So the next class within bonds is medium risk. Medium risk is really driven by the duration. The duration's longer, 3 to 5 years. It's you're lending out the money for 3 to 5 years, and the rating needs to be at least semi-quality rating. You can't, buy junk bonds and expect, oh, I'm going to get my money back from this company that might be bankrupt in 2 years. It has to be a good company. And I'm going to highlight General Motors and then an ETF again from Vanguard that invests in intermediate term bonds. So General Motors, I think, is doing really well. I think they announced that their car sales really went up in the third quarter, so good for them. And this bond, it has a 3.5 year duration. So in 3.5 years, they'll return this capital back to me. In the meantime, they'll pay me 6.47% interest rate. And, I don't know that interest rates are going to go up much more. I believe that they're pretty close to the top. I think the Federal Reserve is going to do some big damage if they keep increasing. I don't know what's going to happen, but I think we're at the top. So I think this rate's really good to earn for the next 3.5 years. And again, my capital will be returned in 3.5 years, and I'll be paid 6.5%. I'm still not keeping up with the S&P. There's pretty good gap between this particular bond and the S&P. But again, you can buy a stock. Let's say you buy, hey, I think Pfizer is really undervalued, and you buy it, and in 3.5 years, you may be up 30% on Pfizer. You may be down 30% on Pfizer. And that's the kind of risk that as you look at, maybe you're a retired person or going into retirement, or you're saving up for maybe a home purchase or something, you may not want that type of risk, that volatility. You may want some of your investments to be more preserved, more stable, and that's why bonds have a place in my portfolio or my overall strategy. Looking at the ETF, the Vanguard BIV, which is intermediate bond fund, it's returning 5.21%. Now let's go over some high risk. And with bonds, you're a high risk bond, I would argue, is still low risk compared to a stock. I mean, you can buy like an excellent stock, let's say an Apple, but if you're buying Apple stock right now, I will argue you're at high risk. I think the Apple stock is overbought. I think they have a lot of challenges ahead of them. So even that stock would be at risk, or you name the stock and there's risk in that stock. So a bond's always going to be less risky, but this would be the category of the higher risk bonds. And this bond is issued out by Pemex, which is the petroleum company down in Mexico. And I believe, and I'm not the only one that believes this, is the Mexican economy is doing really well, and it continues to get better and better. And this is the oil company that both sells, oil domestically within Mexico and also exports it. The United States actually imports a significant amount of oil from Mexico. And this is a long duration bond. I get an interest rate return of 12% in that time. So having a longer duration bond and having a high specified rate of return for an organization company that I believe is going to be around in 20 years. At 12%, I'm keeping up with the S&P. I'm diversifying into an investment that is non-stock. So that's all really good from this investment. When you look at an ETF from Vanguard, in this case, the BLV, it will return 5.64%. So that's a quick review of my bond portfolio. I hope you found it interesting. And again, the intent is to diversify, away from stocks so I could have really a skill set and a way of creating a stable way of getting good income out of my investments. And I'm going to continue to study bonds because it is important to have that steady income. I like the steady positive return ratios of bonds as well. So I'll continue to invest in bonds and increase my investment as I get older in my bond portfolio. Thanks for watching. I really appreciate it. Please like the video and subscribe to my channel. And I'd love to hear from you in the comments on what you're doing with bonds, what your interest level is with bonds. I imagine if you're really young, you might say pass completely, which I totally understand. If you're older like I am, you might be interested in bonds, and I'd love to hear from you and see what you're doing. Any ideas you have are welcome. Thanks again for watching. Good luck investing in 2023.